All right.
Hello and welcome. Today, we're going to deconstruct what I like to call the financial X-ray of a company, the statement of financial position. It's an incredibly powerful tool that gives us a clear, instantaneous snapshot of a company's financial health at one specific moment in time.
So here's our game plan. We'll start with the basics of this financial snapshot. Then we'll break down what a company owns versus what it owes. After that, we'll see how to actually use this information to check a company's health. And we'll wrap up with the fundamental rules that make it all trustworthy.
Okay, let's jump right in. Before we can even begin to look at the numbers, we have to get a handle on what this statement is actually for. What's its core purpose?
The key word here is classified. And all that means is that it's organized. It's the difference between a shoebox full of receipts and a perfectly organized filing cabinet, right? By grouping similar items together, we turn a potential mess of data into something we can actually analyze and understand.
And really, this whole detailed document boils down to helping us answer two fundamental questions. First, can the company pay its bills on time? And second, who actually has a claim on all the stuff the company owns? Is it the lenders or is it the owners? That's what we're trying to figure out.
All right, let's move on to the first big piece of the puzzle, assets. Simply put, this is all the stuff the company owns, the resources it controls that will provide some future economic benefit.
Now, when we look at assets, the main dividing line is time. We sort them into two basic categories, current and non-current. Think of current assets as anything the company expects to use up or turn into cash within about a year. Everything else, all the long-term stuff, the real foundation of the business, that gets classified as non-current.
And here are some classic examples. You've got cash, of course, then things like accounts receivable and inventory. You'll usually see these listed in a specific order, which we call the order of liquidity. It's just a way of starting with what's already cash and then listing everything else by how quickly it could become cash.
Now, here's where it gets really interesting. An asset's classification isn't just about what it is, it's about what it's for. Take a home builder, for instance. If they own a piece of land that they intend to build on and sell this year, that land is essentially their product. So we classify it as inventory, which is a current asset.
But what if that same company owns another piece of land, and on that land sits their corporate headquarters? Well, they're not planning to sell the office, are they? It's part of their long-term infrastructure. So that land is now classified completely differently, as a non-current asset under property, plant, and equipment.
And let's take it one step further. What if they own a third plot of land that they're just holding on to, maybe planning to develop 5 years down the road? Well, it's not inventory, and it's not part of their day-to-day operations. It's a strategic resource for the future. So we classify it as a non-current long-term investment. See that? Same asset, land, but its purpose completely changes its place on the statement. So we've covered the what you own side of the equation. Now let's flip the coin and look at the what you owe side. This brings us to liabilities and equity, which are really just the claims against all those assets we just talked about.
And just like with assets, we use that same one-year time horizon to sort things out. Current liabilities are the bills and debts that are due pretty soon, within the year. Non-current liabilities, on the other hand, are the long-haul debts, like a big mortgage on a building or bonds that won't be paid off for many years.
Okay, so after you've accounted for everything the company moves to outsiders, what's left? Well, whatever is left over belongs to the owners. That's what we call shareholders' equity, and it's mainly made of two things: share capital, which is the money investors originally put into the company, and retained earnings, which is all the profit the company has made and decided to plow back into the business over the years.
All right, we've got all the pieces on the table. Now for the really useful part, putting it all together to actually diagnose the company's health. This is where we move beyond just listing numbers and start to gain some real insight using what we call ratio analysis.
I think this doctor analogy is absolutely perfect. Think about it. A single blood test result doesn't tell you everything, does it? The doctor looks at all the tests together, compares them to benchmarks, and then makes the diagnosis. Financial ratios are exactly the same. No single number tells the whole story. It's the full picture that really matters.
So one of the first tests we run is for liquidity, which is just a fancy way of asking, can the company pay its upcoming bills? The go-to tool for this is the current ratio. It's simple. Current assets divided by current liabilities. So in this example, a ratio of 1.6 to 1 means for every dollar in bills due soon, the company has $1.60 in short-term assets ready to cover it.
But here's the key question. Is 1.6 any good? Well, it depends.
Context is everything. It's certainly better than having a ratio less than 1. But the real insight comes from comparison. If the industry average is 1.8, our company is lagging a bit behind its peers. It doesn't necessarily scream disaster, but it definitely makes you raise an eyebrow and ask, what's going on here?
Okay, so that was short-term health. What about the long term? For that, we look at solvency, basically the company's ability to survive in the long run. A key ratio here is debt to total assets. It tells us what percentage of the company's stuff was paid for with borrowed money. A figure of 40% means creditors have a claim on 40 cents of every single dollar of company assets. That's a huge indicator of financial risk.
Of course, all of this analysis is completely useless if the numbers themselves are unreliable, right? For any of this to work, we have to be able to trust the data. And that brings us to the bedrock of all accounting, the rules of reporting.
At the heart of these rules are two main ideas. First, the information has to be relevant. That means it has to be useful and actually matter enough to influence someone's decision. Second, it has to be a faithful representation of reality. In other words, the numbers need to tell the true story by being complete, neutral, and free from major errors. Here's a great practical example of relevance in action, the idea of materiality. Imagine a huge company buys a $36 pencil sharpener. Technically, it's an asset that will last for years. Should they really go through the hassle of depreciating it by $6 a year for 6 years? Of course not. The amount is so tiny, so immaterial, that it couldn't possibly change an investor's mind. So common sense wins, and they just expense it right away.
And this leads us to one of the biggest ongoing debates in accounting. How exactly should we value things? Do we use historical cost, what we originally paid for it? That number is solid, it's objective, you have a receipt for it. Or do we use fair value, what it's worth on the market today? That's arguably more relevant, but it can also be a moving target and much more subjective. And that leaves us with the final, thought-provoking question. This tension between the verifiable certainty of historical cost and the timely relevance of fair value is constantly shaping accounting standards. It makes you wonder which method ultimately tells the truer story of a company's worth, the rock-solid number from the past or the ever-changing value of today. It's something to think about.